Our companies are investing aggressively now because they see enormous opportunities, whether it's in the genomic space, the robotic space, energy storage, artificial intelligence, blockchain technology. So we have, I think, one of the most massive misallocations of capital in the history of mankind. You have investors investing in the past. What we do is focus on innovation. The biggest surprise to us in the last 3 years is the amazing set of breakthroughs in artificial intelligence. We've got AI costs. We've got AI moving more than twice as fast as Moore's Law. Costs dropping 60% per year if you account for both the hardware and the software. When you get the cost of something dropping that much and to levels that are much more accessible and affordable, you're going to have an explosion in creativity. And that's what's happening. What has happened to our world, our traditional financial world, is intense risk aversion caused by, first, the tech and telecom bust in the early 2000s, and then even more so after 08, 09. And what does risk aversion mean in the traditional world? Risk aversion means get close to your benchmark sensitivity. So we have, I think, one of the most massive misallocations of capital in the history of mankind. You have investors investing in the past. Benchmarks are where they are, and especially the largest companies and stocks in the benchmarks are where they are because of past successes. If we're right, those are the companies that are going to be disrupted. And you can see, if you look at large cap growth portfolios or large cap any portfolios practically, you'll see many of the same stocks, but in growth, you'll see the FANGs, you'll see Microsoft, you'll see NVIDIA, you'll see Tesla, because it was put in the benchmark finding. Only one we overlap with is Tesla.
Why such a reticence, though, to concede that some of these stocks that have suffered dramatic declines will never come back to the level at which they once were? You won't concede that? You think all of these stocks that I read on that list, plus others that are down by significant amounts as well, are really going to come back to the prior levels they were?
Absolutely. And beyond. You'll notice what we do during risk-off periods. And this one has been particularly long, 1 year, which has taken our stocks into bargain basement pricing, I'll say again. But the names you read have migrated into our top 10 because we have concentrated our holdings towards our highest conviction names. And most of the names you read are in our top 10. I think many of them are platform companies. Many of them are going to harness artificial intelligence in a way that others cannot. I mean, Tesla has been the best case in point, and I think we have a lot of Tesla-like stocks in our portfolio. We're really looking for companies that are going to use artificial intelligence and create competitive advantages that no one will be able to catch.
I agree with you about the pendulum having swung very far. I don't know if it's all the way yet. It's hard to without the benefit of hindsight. But every time I want to pull the trigger and buy your flagship fund, ARKK, two things stop me, and maybe you can talk me and other people who are watching out of these two problems that I have. The first is not in your control, and that is the inflationary environment and what's going on with rates. If this is your strategy and you're going to stick to it, unfortunately, you're up against a headwind that is not of your making, and really there's not much that you can do about until it abates, which is that historically, go back through the last 100 years, break it down in decades. Decades with high inflation were very bad for growth stocks relative to value stocks. Just look at the 2 decades with the highest inflation, the 1940s coming out of the war and the 1970s. In those 2 periods, using FAMA French indexes, value outperformed growth on an average annualized basis by more than 10%. That is an insurmountable hurdle to anybody concentrating in growth stocks if, in fact, high inflation is going to persist. Again, that's not your problem, but I'd love to hear your take on that. The second thing is a little bit more idiosyncratic to ARK and the way that you guys do portfolio construction, which is that there tend to be a lot of glamour stocks in your index and in your products that maybe aren't that innovative. And a couple of examples that come to mind, I was kicking the tires on your genomics fund. I can't get past the fact that Teladoc is the largest holding. In what way, shape, or form is Teladoc at all involved in genomics? DraftKings, Robinhood, these are not really innovative companies. One is a bookie, and one is a fairly traditional broker that made its way by breaking a lot of brokerage rules. I don't see innovation there when I see those names, and that's why I'm not an investor as badly as I want to be. Can you talk me out of those concerns that I have? Because I think they're shared by a lot of the people watching today.
Sure. Absolutely. And Josh, I heard that you had some kind words to say about us as a firm, or generally. So I thank you for those a few weeks ago.
I think very highly of you.
Thank you, Josh. So on the first, inflation. Okay, my background is economics, both economics and finance, and do have a point of view here. The supply chain issues have lasted so much longer than we anticipated that they would take a while to work out, but not 2 years. So the question is this supply chain related, and will these inflation metrics unwind? I think a lot of what's going on is supply chain related. I know it's become unfashionable to use the word transitory, and so we won't, because it's lasted longer than we expected. However, I do think there's going to that the deflationary forces that are building up in the economy today are pretty strong. Two are secular, one is cyclical, and the bond market is sort of getting this. If you look at what's happened to the yield curve, so the difference between long rates and short rates, it has flattened from, I think, 155 basis points last March to 45 basis points today. And if the Fed did go 50 basis points in March, which they might, I think that it would be one and done then, we'll end up with an inverted yield curve. And then what are people going to think? Well, an inverted yield curve and the flattening yield curve says, watch out. Something's going on here. Either growth is going to disappoint, or inflation is going to be much lower than expected, or both. And we think both is right. And so that's the cyclical source. There's an inventory buildup. If you look at the record-breaking inventory buildup in the fourth quarter GDP report, you'll get a sense, while inventory to sales ratios might be low, as the consumer switches off here. And if you look at the last 3 months of either retail sales or consumption, the consumer has gone pretty flat. Meanwhile, you've got the double ordering and triple ordering by manufacturers and wholesalers because they were missing sales before. So I think there's a big inventory problem brewing here. And it's going to hit within the next 6 months in terms of that recognition. That's the cyclical side of inflation. The secular side has to do with innovation. So our focus is understanding cost declines associated with technology, and when costs are going to drop low enough so that demand in different sectors will pick up. Just give you a